You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
Pumpkin spice lattes. You know what time it is, baby. It's after Labor Day, and that's when Dunkin' and Starbucks and all those people start to pump your veins full of pumpkin spice. I don't know if that creates productivity or not, but God, our economy could use some real productivity and some real caffeine to boost it up a little bit more, Matt. What do you think?
Well, Andy, another sign that the apocalypse is upon us, we recently purchased as a family pumpkin spice latte flavored goldfish. So combining the world's favorite childhood snack with, I guess, the world's favorite fall flavor into one weird concoction, and it was a one and done for us, I will have to say.
Interesting. Yes. Sometimes innovations don't pan out. Good for you to be brave to try it out. I myself would have kept walking down the aisle and scoffed at it unmercifully at the grocery store. But good for you, Matt. I guess I'll just stick to what's in my coffee. But speaking, I think one of the biggest challenges that we've seen over the last, the biggest shift, I guess, and challenge is we're in springtime. We're talking to all these CEOs. We're talking to all these directors and managers. And, working at FDRA is really fascinating and fun because we get this inside look in companies where no one else would be able to. And we can utilize that to figure out where the industry's headed. And when we were looking in springtime and having conversations about allergies, it really was about the supply chain. I mean, it was overwhelmingly about the supply chain and getting product in. Summertime hits and everybody's starting to realize that, oh my gosh, I probably brought too much product in and things are softening. And I think now the biggest thing that we're seeing from the conversations we have is what is going to happen in the fall and for holiday with consumers. Where are they going to be shopping? How much are they going to be spending? Mm-hmm. Are we going to be okay? Right? Supply chain to sales really quickly. And that's what post Labor Day is an interesting time. And I know we've got Gary Rains, our chief economist, on this call as well. And I think
Gary Rains.
Yeah, I think we're just going to wrap a bit about where our current economy is, and then I think where we're headed. And we'll try to be logical, and I'll try to be more optimistic than what I feel in my gut.
Will you be as logical as the Fed, Andy? I mean, that's the question. Will you be as logical as Chairman Powell? Maybe Gary will answer that question.
I don't know, man. I feel like I feel like we had this big shift in our economy and in business and industry. And for some reason, the Fed was not using updated tools or looking in different places. They were looking at traditional numbers that don't make any sense in this world that we're in now. And I don't know. Gary can speak to that for sure. Gary?
Yeah, I have to say I'm not so much the optimist or the pessimist as just the realist, and I do not feel very, very upbeat on prospects at all. I know I've been beating the downbeat drum for quite some time, but it's not because I'm naturally a pessimist. I'm just, as they say, calling it like I see it, and I do not feel good on the prospects headed into fourth quarter at all.
Yeah, well, I mean, let's talk really quickly about where we're at right now, right? We got through the summer. Mm-hmm. Demand has been softening. We've seen that. It hasn't been – nothing's fallen off the cliff, right? Things have just been like on a slow decline of things. But also we did have I think it was June, total June sales was a record again. So I think it's difficult because people are looking at their balance sheets and seeing what happened last year. They're seeing what happened this year. It's already a tough comp. And I think for me – from a behavioral economic standpoint, not just a data analysis standpoint, there's a psychological shift that happens after Labor Day. The pool's starting to close. The kids are back in school. The summer fun kind of ends. And that's when the credit card bills start coming due, right? And then that's when you start buckling down. And you say, okay, we had a great summer, but oh my gosh, we probably spent too much at Myrtle Beach. Or those airbrush T-shirts that we got.
Well, that's a global problem, Andy, because the credit card burden globally is like instantly through the roof. I mean,
Right.
So what you're saying is true, and the data is starting to show that out.
Yeah. So Gary, how do you see that? As a psychological breakpoint where we have all this debt accumulated, and it's coming due. And what does that do for disposable income when we don't have any stimulus money being pumped out into the market anymore?
Yeah, absolutely. Two issues. The first one, you're right. The latest data of consumer spending were through July, and it showed that July footwear spending actually was a record. It was a seasonally adjusted, annualized $106.6 billion in July in the U.S. It was up some 6.4%, which is a great number. In any other time, that's a fantastic number. The problem is that is in current dollars. Once you adjust for inflation, year-over-year footwear spending was essentially flat in July, and that follows the 4 previous months when we had declines. So, half full, half empty. In current dollars, things are looking pretty upbeat, and we're set to have a record year again in 2022. In inflation-adjusted dollars, no. We're seeing essentially less volume of footwear being sold in 2022. Yeah. Second issue, looking into the last couple of months of the year, of course, everyone has seen how the Fed has been raising interest rates, the bigger chunk of this year, and it's a bit like turning a battleship. It's not happening quickly, and it takes months and months for these higher rates to trickle across the economy. And as Matt had said, not only are we seeing record credit card balances in the U.S., but now you're seeing those higher interest rates very quickly impacting credit card interest rates. So it's kind of a double whammy. You've got higher balances and higher rates on those outstanding balances, and I think that's really going to crimp disposable incomes as we get deeper into fourth quarter and holiday season.
Well, if you think about kind of what's interesting about all this is that we're coming off like the greatest year in the history of mankind for footwear, right? So the party has been like raging. The keg stands have been plentiful, and the fun has been nonstop, all at full price. And so when you go from $87 billion prior record, 100.3 or 7, whatever it was, just over $100 billion last year. Now we're measuring 22 against the greatest year of all time. And so I think people are concerned, and there's hand-wringing, but people are hand-wringing from a position of strength, meaning there's a lot of cash they're sitting on. And this is not clearly consumer-focused, but more of kind of how our companies are navigating this. This is a lot different than spring of 20 when it was like, are we going to survive the next 6 weeks? And I think that we have to keep that in context. Even our 22 numbers are showing, at least on the internal side, we talked about this on the member call, they're showing, relative strength to last year at this time. Maybe not 2019, but I think there's kind of this recency effect, like we're doom and gloom. At the same time, we just had a really awesome raging party. Sure. And we're starting to sweep up the confetti and starting to pay the bills, Andy said, and it's not fun. But it's not like as dire as it was in the spring of 20.
Well, I hope people are saving their money. If anybody's not saving their money as a company, there's a big problem in the leadership. You need to be stacking cash. We don't know what the midterms are going to bring. We don't know what upcoming presidential cycles will bring. It's not that far away, and I don't want to get into the politics, but you have a shift that can occur or not occur. But taxes are going to shift and change. We've already seen some of that happening in Washington. So you have uncertainty there. We have uncertainty about what's going forward with consumer spending, with product, with channel. There's just a lot of uncertainty. So, I think that was one of the big lessons when we talked to some of the major company CEOs was how important it was to have capital in hand during the crisis. So I'm sure they did, but it does behoove people to tighten the belt a little bit. But then that causes... If every company's doing that, it causes massive problems in the economy, and it becomes a self-fulfilled prophecy where you're talking about sweeping up the confetti. I'm thinking about a hangover. Hangovers come due if you party too hard. It always happens. And my concern is that if everybody's pulling back and they're not putting money into R&D or investment or hiring out and they're just trying to trim and be nimble, that's exactly what they're supposed to do. But what happens in mass across the economy, that it becomes a self-fulfilled recession that we can see because there's not money flowing normally like it should. And I especially think that, again, that psychological thing switches off our brains come September when we start to buckle down a bit more as consumers, because we know, in terms of spending over the fall, you do back to school for your kids. And then there's not really maybe Halloween on some costumes and candy and stuff, but there's not really anything dynamic enough over that period of time until we hit November where holiday sales start, right? So we've got this really challenging psychological time where people got to pay their credit card debt. There's nothing extremely fun to spend money on from September to November. Maybe Amazon Prime Day is placed in these areas strategically over time. But that's my concern, is like there is going to be a pullback that we will see simply because even if there are sales and they're trying to move that inventory, the consumer is going to be in a different psychological space than they were over the summertime with their own jet skis and getting airbrush T-shirts and eating ice cream, right? So
yeah, well,
that's where my mind is.
I want to unpack what you said with Gary about the self-fulfilled recession, because it's really interesting to me. My father-in-law has always said, like, the most powerful man in the U.S. is not the president of the United States or in the world, is the chairman of the Fed, right? Yeah. The president might have the nuclear codes. Maybe they're at Mar-a-Lago at this point. But the chairman of the Fed can make a decision, make a speech, and billions and trillions of dollars evaporate or added to our economy instantly at times. And so it's interesting that that's essentially what they're trying to do now, right? When the jobs report came out in July and there was over 500,000 jobs created, it was like, oh, crap, what are we going to do? The economy is too hot, right? And so, Gary, as you think about this self-fulfilled recession, it's kind of what they want to do. It's kind of what they're driving towards with these rate increases. They want slower economic numbers. They want less job creation. They want negative growth, if that's even a thing. And so isn't that kind of the name of the game right now as the Fed looks at policy options?
Yeah, in fact, you really echoed a lot of what Jay Powell had to say at the recent economic symposium going on in Jackson Hole, to where he really echoed Paul Volcker from 40 some years ago, to where he said it's not just about where inflation is, but it's about inflation expectations. And if everyone, talking about that self-fulfilling prophecy, if everyone is headed for the exits at the end of the party, then everyone's going to head for the exits. But if everyone doesn't think everyone's headed for the exits, then you could have that proverbial soft landing. I think inflation expectations are pretty high now. The Fed's aware of this, and of course, Chairman Powell's words were very somber, not only in his tone, but the words themselves. And I think he was trying to dampen down some of that inflation expectation sentiment that's so high out there now. So yeah, I think that's something that's going to carry on into fourth quarter. Are we going to see the consumers become less ingrained with that high inflation idea leading into 2023, or is that something that's going to persist deeper into the new year?
I also look at the global economic picture too, because as much as people want to think globalization's dead, we're still very integrated in many ways. And I look at obviously what's happening in China. They're going through a real estate debt crisis. And it's at the point now where the Chinese government can't necessarily step in and fund different things. Otherwise, they're stepping in the same thing that we're getting involved with here in the U.S. on the student loan forgiveness, which is the expectation that they'll always keep stepping in to pop bubbles, et cetera. And they don't necessarily want to get into that. And it's a crisis of confidence and a whole structural system where their GDP growth has been directly tied to real estate. In many ways that people don't realize or understand, but it's the huge driver of their GDP. And I think in the first half of the year, something like their revenue plummeted 96% year over year or something like that. So they're like in dire straits with that. So you got a Chinese consumer who's a little bit nervous, not investing, pulling back a little bit. You look at Europe and you've got, even with price caps on energy that you're seeing in the UK and in Europe, trying to help make sure that utility companies don't gouge people because of supply issues. But you got these folks that are going to be spending 4,000 to 8,000 pounds, 4,000 to 8,000 euros over the winter to heat their homes, and that's just sucking out disposable income right and left. I mean, we're very fortunate here that we don't necessarily have that same problem, even though prices have been high. The gas prices are sort of moderating at this point. But I think of companies who have been trying to use strategy to sell overseas to help like bump up revenue here and there, especially in China, is now going to have this impact where it's like everything is not going to be flat overseas. Like hopefully it is here. If we have a flat year, congratulations. But overseas, there's going to be declines. There's going to be declines in Europe, and that's going to impact companies in a different way. And I just think that is going to drag on our economy in ways that people don't think about.
You bring up a good point. Within foreign trade, exchange rates and inflation rates between different countries are a bit like a balloon. You squeeze on one side of the balloon and the other side, puffs up, and vice versa. The thing that I think many people aren't appreciating now is the dollar is really strong, and at the same time, like you said, you're seeing disposable incomes, so low in so much of the rest of the world, and economic activity slowing down, even in China, not to mention Europe. So you got this kind of twofold issue that the demand is low and the dollar is strong, particularly against the euro and the Chinese yuan. So you can't really export that inflation overseas, or essentially move that demand overseas. So you're stuck with the situation in the United States, and you aren't able to squeeze on one side of the balloon and essentially export that inflation to someone else, make it their problem, because the currencies overseas are relatively weak versus the dollar now. So yeah, it really limits the ability to see foreign demand pick up the slack in the United States.
Yeah.
I think the irony, though, for as we bring it back to the U.S., is the fact that because we know the inventory to sales ratio levels have increased, we know that anecdotally, we know it through the data, Gary, that we have at FDRA.org, and so that in of itself, in theory, should drive actually more promotional and pricing activity that to the benefit of the consumer, which ultimately would lower inflation, at least within our sector. And I assume that other industries on the consumer goods side are having similar challenges and have kind of overbought at this point. We've seen the cancellation notices from Walmart and Target and others, basically millions of dollars in orders canceled overnight. Anecdotally, you're talking to our companies who say, hey, we get cancellations if one thing change, like one comma on an agreement changes, then all of a sudden the cancellation gets thrown down, and the justification is there for the retailer. And so there's a lot of kind of not it going on right now as it relates to the inventory question. But consumers, in theory, should start to see some promotional opportunities with the softening of the pricing that we expect to happen. And so, Gary, from your estimation, how long do you think that will take? If we hear it kind of anecdotally, we're seeing the data and inventories going up, how quick do you expect kind of the price decreases, not maybe going back to deflationary like the last decade that we've seen prior to this year, but how much price softening do you expect to happen over the next 6 months as we head towards the back half of the year?
It's funny you ask. It's kind of the running joke in economic circles that the government always has this 2% target for inflation. And you look at all these different government forecasts over the last several years, and they all show the numbers trending back to 2%, regardless of where the current inflation rate is now. And sure enough, with the current inflation rate as high as it is now, they're still showing it trailing off to 2% in a relatively short period of time. I don't see that happening. I expect to see the inflation rate will moderate. It'll ease, but it's not going to head back to 2% anytime soon. And certainly nothing deflationary, really, I think in the next several years. I do think, as you said, we're seeing the inventory numbers increase rapidly, and that's increasing that inventory to sales ratio, which is fundamental evidence that, the inflation rate may moderate. But returning the 2%, no, I don't see that really on the near or medium term horizon at all.
And I think there's a logical explanation of that is in a marketplace, the cost of materials and making product goes up and down, right? But
Sure.
Labor and wages usually never go down unless you lay people off, right? You look at your total balance sheet. But if you need labor, and what we've seen is talent gets paid more, and we've seen people try to pay a lot. I mean, we're talking about $22 an hour for fast food employees in California. The labor doesn't decrease. So you've increased your labor costs significantly over the past 2 years to service your customer. And that's the thing is like 2%, give me a break. Like that, like, you know, if we're talking about decreasing in prices, it can only decrease to a certain point where you're losing your pants. So it's just, you know, like, I just think that's what it is. It's like, if you just look at the labor costs that we have in our society today, which is great. I mean, labor costs should go up. You know, it's been dragging for a bit, and that's great. But it becomes a point by which the plateau goes up for where your margins are and what you can do. So that's how I look at it.
Yeah, the wage rates, year-over-year increases in wage rates have lagged the year-over-year rate of inflation for the last several years. So yeah, you're right that maybe it's a time for some come uppance to see that trend reverse a bit. But at the same time, once those wage rates go up, the horse is out of the barn, and that horse is not going back in anytime soon. Certainly, commodity costs can fluctuate, manufacturing costs can fluctuate. But once wage rates go up, employees are not going to say, "Yeah, sure, I'm willing to take a wage cut to keep the job." Once those wage rates are higher, they stay higher.
You could offer them that.
This is a good spot to actually do a little self-promotion on FDRA.org, because members have access to wage rates for footwear retail. We have the commodities report, to your point, on material costs and energy costs. So we are tracking this constantly, and every weekly call, Gary kind of runs through quick hits as things that are popping up on the costing side. So people should be paying attention and accessing the Intel Center. And if you're not an FDRA member, you should join right away. Shoot us a note at info@fdra.org.
Yeah, that's a great point. And I, at this point, we're nearing our time to wrap. But I would say, if you do want to offer your employees a wage decrease, then you're going to have bigger problems when they set your store on fire. So just be careful what you're trying to do with your company and your business, because I think there's just a lot of, as much as we talk about the economics, we couldn't get into it. There's a lot of social movement and a lot of social angst in America today, coming out of COVID lockdowns, but also there's just a lot of churn happening. There's a lot of people who have lost their patience and kindness, and
true.
So and it does impact workers, and it does impact business, and it's a whole other like social science discussion that maybe we'll get into at some other point. But with that, Gary, thanks for coming on and sharing a little bit from the data side and fleshing out some of this stuff for us, as always. And as Matt said, our members, every Tuesday at 2 p.m., Gary comes on, and he typically has some great 80s or 90s references to tee us up. So it's always appreciated. Thank you.
Very true. We had Prince this past week, Winger the week before. Yeah. Living Color. I mean, the hits keep coming.
Wow. Well, Purple Rain, everybody. Get your lattes while you still can before they start moving into the winter brews. But with that, we thank you for listening. Shoeandshow.com is our website with our entire catalog. Make sure you go back there and listen to any previous episodes. We've had some great leaders come on and share a lot of discussion around culture, around business shifts, around new ideas. So this is the business. This is the podcast for the footwear business side, and we really are trying to drive in to these topics and conversations and help you do your business a little bit better. We appreciate your time and listening to us. And until next time, enjoy the coming fall from the heat we've had this summer. And we hope to see you soon at some of the events we have now coming up, including Fanny in late November. And until that time, thank you again. Shoe-In is out.
Shoe-In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.